What is a prescribed rate interest loan? How does it work? And how can you benefit? That topic right here, right now. Hey guys, I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. A prescribed rate loan is something that can be used in tax planning tools to properly reduce your income tax benefit, especially if you have non-registered or corporate assets. How does it work? It's a little complicated, but basically it involves you, an individual, lending money to another legal entity, perhaps a corporation, perhaps a spouse, perhaps a child. Let's get into how it works. As a reminder, please take a sec to subscribe, press the red button, like if you're watching on Facebook, if you're watching on Netflix, if you're watching on Instagram or YouTube. You're probably not watching on Netflix, but regardless, take a sec to subscribe. Also, if you'd like to book a no obligation consultation, please go to www.speaktorob.com. We'd love to book that for you. So the prescribed rate loan is basically created when an investment capital, so after tax dollars, is loaned to a third party. So typically the way we see this happen is the loaner, the individual loaning the money, will be a high income family member. So he's lending the money. He or she is lending the money, and he's lending it to a lower income family member, the borrower. And they're using some sort of formal written loan agreement. The key here is to have a disparity between their tax rate. We call that tax arbitrage. For example, let's say Jane has a very, very high tax rate. Jane's makes 200 plus thousand, 250 plus thousand. She's got a 50% tax rate, and her husband, Joe, doesn't work, has zero income, and there's no taxable income in Joe's name. An ideal situation there is Jane would lend money using a prescribed loan, all right, to her husband, and then the non-registered income would not be taxable in her name. So how does this happen? First of all, we all know that we need to pay tax on non-registered income. So if you have non-registered assets, either personally, so this is outside of an RSP, outside of a tax-free savings account, outside of an RESP, a non-registered account that you have, we pay income tax on the income that is generated from that account. Okay, same with a corporate account. If you have a corporate account, let's say a holding company or an operating company, you have assets in that account, the income that is generated from those assets, you need to declare. You're either going to get a T3, a T5, maybe some capital gains, and that becomes taxable income for either you personally or for your corporation. If you're at a high tax bracket, that's not good, right? Because you're getting now taxed at the highest tax rate. An example, there's typically three ways you can get income. If you have interest income, that's going to be taxed at the highest tax rate. So if you have bonds, debentures, or anything that pays interest income, term deposits, GICs, taxed at the top tax rate. If you have dividends, you get the dividend tax credit, but it's still taxed fairly high. And if you have capital gains, it's taxed at roughly half the value. So assuming, you got $1 million and you generate 5% of annual taxable income, that's $50,000. If I were to get that for myself, or if Jane were to get that for herself, she would have to pay tax on $50,000. If she's at the top tax bracket, she's now lost roughly half of that, okay? Half of that to tax. The solution, she lends that $1 million through a prescribed loan to her husband. She charges her husband 1%, which is the prescribed interest rate minimum. And her husband there has all the declared income personally. The key is to have the individual that has the lower income earn the income. A couple things you need to make sure. You need to make sure you have a written agreement, and that agreement needs to be at least at the CRA's prescribed interest rate for the quarter. So right now that's 1%. They adjust it every quarter. It's likely to stay at 1% for a while, I would imagine. Now, you need to have a clear plan for loan interest repayment, and the repayment must be done before January 30th of each year. The loan interest must also be included in the taxable income of the lender. So Jane's got to declare that she lent $1 million and Jane collected $10,000 of interest in lending that money. Now, you can also have a potential tax deduction of the interest paid by the borrower if the loan funds are used for investment purposes. You probably know this, but if you don't, if you're borrowing to invest, CRA allows you to deduct that interest expense. Key point. Now, there's no limit on the amount. There's no limit on the length of time. You don't have to pay it back. You need to pay the interest. You need to pay the interest annually before Jan 30th, but that's it. The big thing you have to remember here is it's a huge tax saving strategy. You could effectively do tax arbitrage provided you have an account that's generating more than 1% interest income. You should have that. Unless you got your cash sitting, in a credit union earning less than 1%, you're getting more than that with pretty much any investment professional on the planet. So higher income earner lends money, lower income earner declares the income, lower income earner pays higher income earner, the prescribed interest rate, which is currently 1%, and higher income earner declares that 1% of income. The tax savings is the arbitrage, the amount of tax percentage that you're saving on that $1,000,000. It could be significant. Remember though, that if you don't make the payments annually, the attribution rules will apply. So in other words, if you forget to make the payments in the future, CRA will attribute that income to the higher earner. So you'll lose the advantage. So make absolutely sure you make your payment before January 30th of the year. And remember that that payment is currently set at 1% annualized. What we typically do for clients, we'll set up a spreadsheet. We'll say, here's how much you lent. Here's the number of days. We'll calculate it for them. And we'll just do an inter-account transfer. That's the easiest way to do it. And we'll do that in January of every single year. The prescribed loan can happen spouse, right? Husband to wife or wife to husband or spouse to spouse, whichever. Could also happen to a corporation, could also happen to a family trust. If you want to divide the income between your family trust and between your beneficiaries of your family trust, it is a huge, huge tool not many people know about and can lead to big savings for the ultra high net worth and the high net worth. If this is something you'd like to discuss, by all means, please go to www.speaktorob.com. We'd love to book a no obligation consultation to chat about this or anything else that's on your mind. I'm Rob Tatro from robtatro.com, portfolio manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Thank you for tuning in. We'll see you in the next video.